Hello, welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as usual, is Jonathan Charlo, also a partner and our lead analyst. The webinar is scheduled to last approximately 45 to 60 minutes. And afterwards will be posted to the SilverOak website. If you have any questions throughout today's webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not currently working with an advisor here at SilverOak, feel free to contact me directly at 952-896-5701. And before we get started, I'd like to thank Jonathan and John and the rest of the SilverOak team for making today's webinar possible. As is typical, it takes a whole village to get this pulled together and ready for delivery, so I appreciate all of their efforts. For compliance purposes, I do need to note that we will be discussing the overall markets and economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, we have sent out year-end performance reports, and hopefully you've had a chance to review those. If you have any specific questions, please call your SilverOak advisor if we have not already contacted you. And lastly, past performance is no guarantee of future success. So let's look at today's agenda. We'll start with a 10 to 15 minute discussion on the economy and most recent economic data that's been released. We'll transition our discussion into the markets and look at both the fourth quarter of 2018 data as well as the year in total. And we'll actually touch on what's happened since year end. Then we'll transition into SilverOak's outlook going forward. We'll talk about some updates happening here at SilverOak, as well as go through a basic checklist for New Year planning tips, which, by the way, Happy New Year to everybody out there. And then, of course, we'll take any questions after the webinar. If you want to direct those to your SilverOak advisor or direct them to me, that would be fine. So we'll start with the economy, Jonathan. And you say here, continued growth during fourth quarter, but slowing growth in 2019. And I did make a note as I went through the various slides that the teams put together that this particular section has kind of a theme. And moderate, I think, was the theme that I got out of this section on the economy.
Yeah, absolutely. When you look at fourth quarter data, unsurprisingly, it was pretty strong. But we're going to look through some of the charts and graphs, and you're going to see that things look like they're kind of rolling over a little bit. Still very strong, but that's kind of the theme. We've talked in the past about how the soft data after the election really increased in some of the areas, but the hard data didn't really ever match that, except for GDP this past year because of the tax cuts. But a lot of strategists are now talking about how the soft data is catching down to the hard data. And that's something we'll see. And then the other thing I'll just mention is that while we do have a pretty complete look at the economy right now, because of the government shutdown, we are going to be a bit constrained on some of the economic data points going forward. And so if the shutdown persists, as an example, the Bureau of Economic Analysis is not open. And so we won't actually get GDP numbers until they reopen.
All right, well, with that, let's start into some of the details on the economy. And the leading economic indicators is shown here.
Yeah, and I again, I put moderating. It's not necessarily going down much. It was down 0.1% in December. 6 of the 10 indicators were positive, but the caveat is that due to the government shutdown, the conference board actually had to project 3 data series of the 10. And so one could question whether or not they accurately reflected what's really going on. So going forward, I would not be surprised to see the LEE come down a bit more in line with what we're going to see with some of the other data points. And so here, as an example, manufacturer growth is slowing. You can definitely see it on the right side of the chart. It registered 54.1%, a decrease of 5 percentage points from November. Now it is still showing growth, but that growth is slowing. And in December, we saw only 11 of 18 manufacturing industries seeing growth.
And of course, this is U.S., but data just came out of China, and we're starting to see a slowdown in manufacturing in China as well. So it is not just confined to the U.S., but we are seeing that impact pretty much globally.
Absolutely. Here is another chart where I use the term moderating. It's still positive, but it is coming down from its peak. And this is another data set that really jumped after the election. It's really not surprising to think that confidence did decline in January. Part of the issues in what the survey showed is that the government shutdown had an impact, the impact of tariffs and instability in the financial markets, the slowdown we're seeing globally, and the lack of clarity about monetary policies. The Conference Board is another organization that also tracks consumer confidence. It also saw confidence coming down, still relatively good, but again, off of the highs.
Right. I mean, we're seeing here, this is even still above average. To your point, off highs. The Conference Board numbers, I just looked those up, and the most recent was 128.1 from 136.4 in November. And that was down a little bit from the October number of 137.9. But I made special note that October, that number was the highest since 2000. So again, coming off pretty strong numbers, but nonetheless, the trajectory is down.
And over the years, the small business confidence measured by the National Federation of Independent Businesses had always really lagged. And then with the election, we did see a big spike up in small business confidence. And then it actually kind of increased for a time from there. We're coming off of that recent high, but what I would note is we're still kind of in that new stair-step level. So we're going to have to see this year how confidence goes for small businesses, because the tariff situation, I think, is beginning to weigh on potentially business planning, growth plans for the year. So that could have a negative impact to this confidence number going forward. So like other measures, earnings growth has been very strong. Quite frankly, 2018 was a strong year due to the tax cuts. They're going to moderate in 2019, so we're showing kind of what the consensus expectations are for the next 4 quarters. They will be up on a year-over-year basis, but when we look at the next 2 quarters, they're actually going to be sequentially down. And so this year we saw 20% plus earnings growth for many of the quarters. That's going to more moderate into the mid-single digits growth this year. But that is a pretty big deceleration, and the question will be whether people kind of view this as a growth recession, not a recession, but that moderation of that growth. Now, this is an area where things still have been strong. So the most recent number for December, employment growth was up 312,000. We did see the unemployment rate tick up a little bit to 3.9%, but that was really more of a factor of more people looking versus anything else. Now, interestingly, the jobless claims from last week just came out, and they hit a 49-year low. But I will caution you, is that's the filing of new jobless applications, but it does not include federal workers. They're not measured in this number, and those obviously have risen sharply in the last couple of weeks.
The other thing to note on jobs is average hourly earnings increased in 2018 by 3.2%. So the jobs numbers are looking good, but we're also seeing some growth on the hourly earning side. And that 3.2% was the biggest annual increase since the Great Recession. So finally, we're starting to see a pickup in payroll.
So GDP growth has been strong, and so there is a lag in terms of the Bureau of Economic Analysis reporting third quarter numbers is what we have to this point. And they increased at an annual rate of 3.4% in the third quarter. But we have been expecting the fourth quarter numbers to come out, but because of the shutdown, the BEA is closed until further notice. Now, one of the things we should talk about is a lot of the positive factors in the last year actually don't help as much as we go into 2019. So we are expecting GDP growth to slow. And with the length of this shutdown, in the past week, the White House has come out and basically said that the negative impact, even on their own numbers, is almost double what they initially thought. There's some thought that it could impact the first quarter by as much as 0.3 to 0.4%. And there are some people out there saying that typically the first quarter slows anyway from a seasonal standpoint. You put all of these other factors on it, there's some bearish numbers out there for the first quarter. So again, this is one of those things that this is a number again that looks like it's kind of peaking in the short run.
So as we bring everything together based on all of our discussions so far, we have our scorecard. And what we've shown here are the items that are obviously in the positive column, neutral, and negative. And these arrows will indicate whether they're trending more positive or trending more negative. So in this example, housing, we're seeing that actually come down. It's still considered positive, but it's certainly coming down from its highs. Just recently, they announced existing home sales fell by 6.4% in December from the previous month. Home price appreciation slowed 2.9% in December from a year prior. And that was the smallest increase since March of 2012. So we are seeing a slowdown on the housing side. Consumer confidence, which we've kind of touched on, is starting to look a little less positive. Employment still looking good. You touched on that, Jonathan.
Yeah, the only thing I would say as we go through 2019 with the economy kind of at full potential and just the pool of available labor growing tighter and tighter, I think it's going to be harder to see 312,000 months. Point. So yep. I think that rate of growth will also slow.
Good point. Commodity prices improved.
Yeah, they went down, and so that actually would be a positive as you relate the potential for lower costs for consumers. When you think of gasoline prices, it's good for businesses that use commodities as inputs. Their costs come down a bit.
Not good for all of the.
Not necessarily good for the energy companies.
Yes, exactly.
But yeah, chemical companies, they might actually get a benefit.
Sure. Interest rates are turning positive, and the arrow, just so people don't misinterpret this, isn't the interest rates are necessarily going up, it's just they're turning more positive.
Yeah, so for much of last year, they were kind of going up, and so were a negative factor. But in the fourth quarter, we did actually see them come down. And where that could be a positive is we talked about the weakness in housing. The lower interest rates on the margin do help affordability a bit.
Sure. Obviously, U.S. politics trending down. I'm not sure. I think a lot of people would probably shift this one over to the negative, but I suspect that's partly perspective. Certainly not helping anything, though.
Absolutely. So global growth is a factor that we have seen essentially growth slow. The IMF just came out recently and adjusted their global growth numbers for 2019. They adjusted them down, and they're down a pretty good clip from where they were mid last year. So that's going to be a factor we'll want to watch this year. And then as that relates, we're seeing really slowing growth in China. And in fact, their growth rate right now is the lowest they've seen since 1990. And so I just saw a couple article headlines wondering if the global China boom was over. Well, I think that's premature. Certainly, China's growth has slowed. We have the impact of tariffs, and they themselves are trying to jumpstart their economy. So it's going to be a swing factor.
Yeah, that's slowest growth since 1990 you mentioned. That was 6.6%. Boy, if the U.S. could get 6.6%. Wow. And then we did move one from neutral into the negative category, and that was the Eurozone.
Right. So obviously Brexit is still another risk out there, but we are seeing growth slowing. Germany manufacturing growth has slowed significantly. You mentioned kind of slowing manufacturing on a global basis. There's still issues in Italy. You know, when you look at some of the periphery countries in Europe, we're seeing slowing there as well.
So if we put this all together, Jonathan, and really transition it from our scorecard, which you see here, and put it more into our dashboard, that's, again, looking at kind of four major categories. And you can see these starting at the top left on this chart, the economy, then down into the credit markets, then valuations, and market sentiment, then coming kind of to the total composite at the very, very bottom. On this chart, it's a heat map. So basically, if for any of those quarters listed, and the quarters are in the columns, any of those quarters listed, if the box is green, that tends to indicate positive. Gray is more neutral, and of course red is more negative. And we do have a couple of shifts that have been occurring. So we can see here with this first circle that valuations were high, so they were red, and actually have been red since second quarter of 2016. But Jonathan, I think at that time when we showed this data, we also indicated valuations can run high for a long period of time without having major pullbacks. And that's, for the most part, what we saw until, of course, fourth quarter. And now we're having those valuations come more into neutral, basically because the quarter was tough. And we're going to see that in a few minutes, right?
Absolutely. Absolutely.
Then we see market sentiment waning a bit, and we went through a lot of those sentiment numbers already.
Yeah, so market sentiment, so the economic factors, but it also includes actual market performance. And so with the fourth quarter being down, that dragged the overall market sentiment score down.
Good point. And then, of course, we're projecting out, since we haven't yet experienced what's going to happen in the first quarter of 2019 or the second quarter, we're projecting out what that's going to look like, at least based on our estimates. And with market sentiment, we think it's actually going to go from from positive to neutral to actually negative.
Right, and with that shift to negative, a lot of it again is the economic slowing, as well as the markets being down. That goes into it. But if that actually happens, we're then projecting that the composite will go neutral, and we felt that way last quarter, and we basically kind of saw many of those factors that we thought were trending that way actually occur.
And kind of getting back to that theme that I mentioned earlier, the moderate theme, if we look up in the economy and the credit markets, we actually see those kind of moderating more toward the neutral as well, which is going to bring our composite from positive to more of a neutral position in total. And we'll actually see that on the chart where we score the dashboard. And here what we're looking at is the green and orange line. Those represent the composite number. One is the actual composite itself. The other is the 6-month average of the composite. And what we're seeing over to the right is that both items, the current and the 6-month average, we have projected to be falling. Right now, the current is at 3.07. And the 6-month average is at 3.69. Those are important, but also important to note is the threshold. So for the current composite, if that number falls below 3.15, which is the threshold for that number, we consider that to be shifting down into the negative kind of territory. Whereas for the 6-month average, the threshold is 3.25. So as long as that 6-month average is above the 3.25, we would still consider that to be positive territory. So we're getting a little bit conflicting data here in that the current number is shifting down into the negative territory, while the 6-month average is still in the positive territory. But could be projected to go kind of negative here in the next month or two.
Yeah, and absolutely, we are projecting that even the 6-month average is going to fall below that 3.25 within the next couple of quarters.
Sure, and of course we'll have to see as the data gets released, but that is our expectation. I should also mention, Jonathan, I know we've talked about this dashboard a couple of times, but for anybody new to the webinar, we really monitor this as one tool, not the tool, but just one tool, because as that average, the 6-month average starts to fall below the threshold, you'll see the S&P 500 in the blue line, and shortly after that falls below the threshold, within 6 to 12 months, what do you say? We've seen the S&P fall in response. So this is one reason that we're looking at the dashboard so closely.
Absolutely.
So with that, let's transition our discussion from the economy, because remember, everything we've discussed so far is more on the economy, and let's start discussing the markets. And I've already alluded to, if people don't already know, the fourth quarter was a risk-off quarter, or basically that's a fancy way of saying the markets were down, and frankly they were down pretty considerable.
Yeah, in fact, one strategist that I follow called it the December to remember, because it was technically the worst final month of the year since 1931.
Wow, I don't want to remember that one.
No, you'd like to forget it.
Exactly. So let's start with the market summary. And here we actually broke out the performance data into 3 columns. We're going to start with January 1st of 2018 running through October 3rd of 2018, because at least for the US markets, that was kind of the high. October 3rd was the high. Of course, October 4th, Jay Powell spoke, the chairman of the Federal Reserve, and markets didn't really like what he had to say, and we saw the decline start really on the 4th. But up until then, the U.S. equity markets anyway, all very solidly positive. Of course, the international markets were struggling a little bit, not terrible, but they weren't positive. But the U.S. markets up until that date all looked great. Unfortunately, fourth quarter changed everything because these fourth quarter numbers are obviously pretty significantly negative, which then pulled down all of the 2018 annual numbers. Now, what you're going to see is that just the opposite occurred in the bond markets. So as we look at the first two here, the U.S. fixed income and the global fixed income, you're going to see they actually were negative through October 3rd. But they bounced back in the fourth quarter to actually end the year, at least in the U.S. fixed income category, just slightly positive. They eked out a 0.01% positive performance. And of course, these other categories, commodities, Jonathan already mentioned, commodity prices fell, which was kind of a positive for the economy itself.
Yeah, in fact, oil prices were down more than 30%.
Wow.
In the fourth quarter.
Long short didn't really protect much in the fourth quarter, nor did REITs, real estate investment trusts. Looking at the fourth quarter from a value versus growth perspective, you'll see that value actually outperformed for the first time in some period, but growth still outperformed for the year. Now, we'll look in the next slide, I think it is, Jonathan, to see that during the quarter, growth got hit pretty hard, but nonetheless, for the year, it still eked out ahead of value.
So here we're showing fourth quarter returns first. You're going to see right at the top, energy, it was the worst performing sector. And again, that was driven by that 30 to 35% decline in oil. But besides that, you'll see on the bottom half, you're going to see industrials, technology, consumer discretionary. Those actually declined more than the materials, financial, and communication services on the value side. So that was, as you mentioned, the first quarter in many quarters that we did see value outperform. But then again, when you look at it for the year, growth clearly outperformed. We had healthcare that was positive, consumer discretionary was positive, technology down just a little bit. Coincidentally, utilities being defensive were positive on the value side, but everything else was negative for the year.
And if we reflect back on this value versus growth kind of race as to which one outperforms, here we're going back on the calendar year basis all the way to 1980. If the bar is headed down, that means U.S. growth outperformed for the year, and it kind of gives the magnitude of the outperformance. If the bar is shifting upward, that's a year in which U.S. value outperformed. So, it's pretty obvious to see here that the growth has really had the edge over the last several years, with only one kind of significant exception. However, the question is, will that trend continue? So what we're seeing here, Jonathan, is kind of that cyclical nature of growth versus value?
Yeah, absolutely. So here we're looking at growth versus value over time. It's the trailing 10-year relative total return. And you're going to see that essentially from 2010, right at the bottom, up until recently, growth has had its run. Now, again, does one quarter make a new trend? We don't know. But we do know that we are very, very close to a 2 standard deviation performance differential. And if you look in the past, it means that maybe it becomes a little bit more from where it is, but we do kind of know over long periods of times these cycles do shift.
Sure. Yeah. So the point to take from this is don't go all in with growth. It is, as many things are with investing, very cyclical in nature. Let's talk about international. So we've touched on the US and we've touched on value versus growth. We briefly looked at international, but let's look at it in a little bit more detail.
Right, and so if you remember from the prior chart, we showed that international was down through 10-3. Actually, international started to underperform the US markets really heading back to April in the year, and that was really when the whole trade tariff talk started, and then we did see the dollar make a pretty good run, and so that both of those factors did hit internationals. So here we're looking at the fourth quarter returns, and so interestingly, if you look at MSCI BRIC and emerging markets, they're down, but they're not down as much as the right side. We're looking at UK, France, and Germany. This is what we were alluding to with those global growth numbers slowing, and why we moved the Eurozone to the negative column, is we were definitely seeing slowing, and it was affecting the markets in Western Europe. Now, when we look at the year, everything was down. China was down substantially, BRIC and emerging markets down. But again, interestingly, Germany was really the worst performer when we look at it on this chart.
Well, and what we've done here on this next chart is to show that historical race between US and international, and we've shown it on a calendar year basis, just like we did with the value versus growth. If the bar is downward, it is indicating that international outperformed for that particular year, and to what magnitude. If the bar is upward, it's US outperforming. And just like growth has outperformed the last several years, or at least the majority of the last several years, US has also outperformed the majority of the last several years. And frankly, even in 2017, when international outperformed, I think it was up 30%, but frankly, US was up 25% or something. So both did great. It's just international did slightly better. The real question here is, will that trend of US outperforming continue? Nobody knows, obviously. It is very cyclical as you look back at the chart. But one point to make, and I think, Jonathan, it's an important point that you brought up, and this chart really speaks to it, is that we've had a very strong bounce off of the Great Recession lows in the US markets. And you can see that looking at the gray line. The other line, and forgive me, it's either blue or purple, I'm colorblind, I'm not sure which.
In this case, I think it is purple.
Okay, purple. That's the international markets, if I'm correct, and we're not seeing that as strong anyway of a bounce off the Great Recession lows.
Yeah, I mean, you look at it, the U.S. up 271% since those lows, whereas international's up 90%. I mean, we can say that certainly the U.S. economy has been stronger. The Federal Reserve was much more aggressive, but this is a pretty big gap, 180 percentage points. We haven't really seen it at this magnitude in prior cycles.
So let's just touch on how bonds did during the big decline. So getting back to kind of that tough fourth quarter of 2018, we obviously know US stocks were down, large caps shown here, mid caps down even more for the fourth quarter, small caps even more. International actually wasn't down quite as much. Of course, they had given up some earlier in the year anyway. Emerging markets not down as much, but again, earlier in the year they'd given up more But bonds, when it really mattered, and when bonds are in portfolios to help mitigate the downside and provide that foundation, they did what they were supposed to do.
Absolutely. Again, they were up 1.6%. So they definitely performed as we would have expected in market instability.
Now, that's not true across all bonds, and we'll see that here. For the fourth quarter, more credit-oriented bonds, or high yield, or I just like to call them what they are, junk bonds, they had a kind of a tougher time.
Absolutely. And so one of the interesting things was when we look back at the year, everyone was focused on interest rates. But in the fourth quarter, I think because of global growth concerns and kind of growth slowing in the U.S., the concern became credit quality.
Mm-hmm.
And so that is also, I think, one of the reasons why small cap equities were hit a little bit more, because they tend to have more debt on their balance sheets.
That's a good point.
So that's kind of what we saw in the fourth quarter. In terms of 2018, if we look to the far right, you're going to see Treasury. It doesn't look like there's anything there. It actually, when we measured the 10-year Treasury from a performance standpoint, it was 0.0. So it was as flat as you could be. So that's what we're seeing there. Tips were down a little bit, but again, that was because of inflation expectations coming down. So we've seen commodity prices come down in the fourth quarter, offsetting the wage increases that we're seeing. But that's really what we saw on tips. And so when we look at kind of the safer areas of the market, Barclays Ag, municipals, very nice positive returns. And then when we look to the left, which we kind of view as a little bit more risky, you'll see emerging market, high yield, corporate bonds down. The corporate area, I think, was pretty hard hit. There have been some concerns about the overall ratings of a lot of what are considered investment grade debt, that right now there are a lot of triple Bs.
Mm-hmm.
And the worry is in the next recession, a lot of those triple Bs become high yield or junk bonds.
Yes.
And so I think that hit the corporate market a bit this year.
Well, the other thing that happened this year, this year being thinking of 2018, is we actually had two spikes in volatility. One early in the year, and then the obvious spike in the latter part of the year.
Yeah, and what's interesting about it is while the decline was worse in the second spike, the first spike was actually much higher. And this is ancient history with the way volatility's been, but that was when those inverse volatility products
Mm-hmm.
failed, if you remember
Mm-hmm.
back to that. But I think the other thing to kind of look at is you'll see kind of in that 2017 to early 2018, we did see volatility grind down to unsustainable levels, in my opinion. We mentioned this later in the webinar, but we think the volatility is generally increasing. And we expect higher volatility than what we saw in 17 and early 18 going forward.
And I looked back, and I believe this was the first time since 1950 that we had two 10% corrections in a single year, as far as 10% declines in the U.S. equity markets. We had one in, February, roughly, and then of course the fourth quarter, which that just obviously hadn't happened for a while.
Yeah, and to also kind of talk about kind of a historical anomaly, typically when January is up, you have a high probability that the year is up. Well,
yes, that didn't work.
We broke the rule this last year.
That didn't work. Well, let's talk about what's happened really since the beginning of the year. So if we look here at the data, we see U.S. fixed income markets are basically break even, just slightly down. But the good news is the equity markets have rebounded significantly since the beginning of the year. And frankly, these numbers are even higher if we looked at the numbers since Christmas. I think Christmas Eve, it was down significantly. Then the day after Christmas, we had kind of an all-time increase in point terms. And so things are up quite a bit more than even this from the bottom. But for the year, U.S. equities on the large cap side up 6.5, mid cap 8.5, small cap 10. They got hit hardest last year, so they bounced a little bit more. International up about 5.5. So a good recovery. Whether it's sustainable or not, that's the question.
Right. And again, we're probably going to see more volatility. So even if the year ends up being a good year, we could have down periods even in this year.
Yes. So what's our outlook? So from an economy perspective, we think the U.S. is likely not to enter into a recession anytime soon anyway. Now, our crystal ball is as good as anybody else's, and you can only see out, maybe 6 to 12 months. I know there's been a lot of folks come out and say, well, a recession later this year or a recession in early 2020. Personally, I think that's because they can only see out that far. They can only see out to the end of the year. We're so far in this cycle that you just assume the recession is right beyond the horizon. You can only see so far. If you can't see the recession, well, it must be just past that. I don't really agree with that perspective, but I don't hear anybody saying a recession is obviously coming in the next 3 to 6 months. Have you heard anything like that?
No. There are a number of organizations that have a recession tracker, so to speak. Risks for the year are up, but nowhere near what you would see typically right before a recession. So, I think that that's the case. But it is certainly talked about a bit more. And the question will be, will that affect consumers?
Yes. Yeah. And not to say that it couldn't happen this year. It's just not obvious in the data thus far. Now, as we'll see here, we're going to have fading effects of the tax cuts, trade policy, which we've touched on a couple of times in today's discussion, could impact GDP. The government shutdown could impact it. So we've got a lot of things here that could impact our outlook as we move forward from month to month. You've talked about earnings, the growth decelerating. Fed policy is probably going to be a little bit more favorable. I think Jay Powell learned from his comments in October that he has to be careful with setting expectations.
And with the shutdown and its likely impact on GDP, I know some people are actually thinking there might be a cut in March. Now, wow. I think that is a big...
Yeah, I would say that's a big...
But I think that he did moderate his talk, and I think markets have kind of calmed down relative to the Fed.
What about internationally?
Yeah, so I mentioned that the IMF recently did lower their 2019 growth rate. They lowered it to 3.5%. Now, that is still a nice number, but when you look at emerging economies growing much faster, that is a bit of a slowdown. It was 3.9% in July. Part of that is Brexit in Europe, which we said is definitely a variable in 19. But the other issue, and we touched upon this before, is that China's growth rate is slowing. Now they're putting in stimulus programs, but it's going to be a swing factor. Will those stimulus programs work? What happens with the trade standoff? Mm-hmm. Do we come to an agreement within the 90-day period that was announced?
So from an equity standpoint, shifting more to the markets, we mentioned valuations look better. We saw that in the dashboard. You had already mentioned a few minutes ago that we expect volatility to pick up. This is probably an ideal time to make sure that you're invested in a diversified portfolio, though. Even though We understand growth's outperformed the last several years. U.S. has outperformed international. I mean, there's been these trends that we've touched on today. We still strongly believe that now, more than ever, a diversified approach is the way to go. Now, having said that, looking to the past 5 or 6 years, a simple U.S. portfolio has definitely beat this more globally diversified portfolio that we and many others consider to be a prudent strategy. As a matter of fact, I think that's a pretty consistent agreement in the industry that having diversification is very, very prudent. Over the last 5 years or so, though, having a very simple 60-40 allocation between U.S. stocks, and specifically U.S. large cap stocks, and 40% in bonds has outperformed a globally diversified 60-40 allocation. Why is that the case, Jonathan?
Well, let's talk about some of the areas we've mentioned. Small caps. Small caps have been a drag in the last few years. International. We showed that chart of the performance differential between the U.S. and international kind of at unprecedented levels.
So the question is the past 5 years indicative of what we're going to see in the next 5 years? And of course, we put the question mark here because nobody really knows. But like many things with investing, this does seem to be very cyclical. And with some of the other data points we gave with regards to international and some of these other markets, we actually believe the diversified portfolio is going to start to outperform the very simple 60-40 U.S. large cap ag type portfolio. So with that, let's talk about our outlook on bonds.
So there was a lot of difference in performance in bonds in terms of how they performed throughout the year. We think that returns will be a bit more normal in 2019. They should really approach more of the underlying bond yield, whereas this past year with rising interest rates, that impacted returns. We mentioned this, but bonds continue to offer protection from the volatility we're likely to see in the equity markets. We mentioned this before, but we think we need to focus on credit quality. If we do continue to slow and there's concerns about growth, it's very likely that investors are going to demand higher returns to take on more risk. And what that means is that the credit spreads for high yield and lower rated bonds would widen, meaning you would have negative performance. And so our managers do focus on that quality. And so we think that's going to be key. And then just finally, with the general increase in interest rates, shorter duration bonds, money markets, CDs, these are instruments that are much more attractive than they were even a year ago.
Yeah, we've actually been buying some CDs as alternatives to just keeping money in cash. So that is definitely something to consider. So again, just summarizing all of this, looking at the dashboard. We've already touched on the dashboard and what the takeaways are, but we wanted to close out that section of the discussion with the dashboard. Let's touch on our SilverOak updates and New Year planning tips. We've got some important updates. First, we're very, very happy to announce that we promoted Alex to a support advisor. So congratulations to Alex. And also we want to welcome Duncan as a new associate paraplanner to the organization. So the firm continues to grow and add talent in various roles throughout the organization. From a IQ standpoint, we do have a large cap growth position that will be merging in March. Two positions are basically going to be coming together, forming one position. So we'll be talking to our clients who are impacted with that merge. We'll also be consolidating several positions that are not widely held amongst our portfolios. There's 2 or 3 or maybe 4 positions that we just don't own widely that we want to consolidate into a couple other positions. Tax loss harvesting is continuing. Actually, the actual harvesting occurred at the end of the year, as everybody knows that was impacted. But because of IRS rules, we can't buy back into the original position until 30 days have elapsed. So that will put us into early February. So we plan on early February potentially transitioning from the temporary positions that we purchased into the prior permanent positions. But for those clients that were impacted, we'll certainly be reaching out to discuss this with you if we haven't already at least once. And of course, tax season starts. Oh, tax season, it comes every year. Be prepared. Start putting your tax documents in a packet so that you can get them sent off to your tax preparer. The sooner you get those sent off, the happier he or she will be. And then I'm also happy to announce that we have finally, Jonathan, completed the update of our SilverOak website. It launched a couple of weeks ago. I want to thank Dan and Sammy and the rest of our team that was so involved in getting that project completed. It looks just absolutely great. I encourage everybody to go out and take a look at it. If anybody has suggestions or recommendations to improve it, certainly feel free to reach out to us and let us know. We're always trying to improve the experience that our clients have. Another New Year planning tip that we want to touch on, I think we talk about this throughout kind of the year, but please do not adjust your risk tolerance solely based on recent market performance. Meaning in November, December, we don't want to see clients shifting more conservatively just because they get a little uncomfortable. And now we don't want clients shifting more aggressively just because we've had a nice bounce off the bottom. We need to have consistency with regards to risk profile and risk tolerance, and really try to avoid that investor bias of chasing returns or allowing most recent performance to kind of dictate our risk profile.
Remember, April 15th is the tax filing deadline. Make sure you have your information compiled. Get the information to your tax preparer in a timely fashion. Now, some of the information won't come out until February, but it still is a good idea to get going on collecting those items. Foreign bank account reporting, 2 reporting requirements. Form 8938 is due with the income tax return, and the FBAR is due with the income tax return. It used to be due later at 6:30, but now it's with your income tax return.
And as Jonathan pointed out, and I think I mentioned, now is a great time to start planning for even 2019. So get your 2018 stuff compiled and start thinking about 2019, whether that's adjusting withholding amounts, making estimated tax payments, just simply creating a good filing system for the year, especially when it comes to charitable donations. Jonathan, you had made note that on January 26th of 2018, we did a webinar about the Tax Cuts and Jobs Act. And slides 41 to 44 of that webinar go through details on what the requirements are as it relates to charitable donations and keeping receipts. So I encourage people to go to our website, look at that January 26th webinar, and specifically slides 41 to 44 for data on charitable receipts and the requirements there. All right, and the other thing, Jonathan, that you had brought up in one of our discussions is, while many people will go to the standard deduction and no longer be itemizing their deductions on their federal tax returns as a result of this new tax legislation, Minnesota is not conforming to those federal rules, meaning that you may be taking the standard deduction on the federal tax return, yet itemizing your deductions on your Minnesota tax return. Going to be a little bit confusing for people this year, but we have not conformed to the federal rules here in Minnesota. Of course, now's a good time to review your 401k statements and rebalance those investments if we haven't already recommended you do so. The annual contribution limit is increasing. The new limit this year for 401ks is $19,000. Remember, there's also the $6,000 catch-up if you're age 50 or older by the end of the year.
You can make an IRA contribution for 2018 and or 19. The only issue is that the limit for 18 is $5,500, and that limit increases by $500 to $6,000 for 2019. The $1,000 catch-up is the same for both years. And to make a 2018 contribution, you have up until you file your taxes on April 15th. Consider a backdoor Roth IRA if applicable. We think that they're definitely a very good tax-advantaged way of saving.
All right. And just one clarification on that IRA contribution for 2018. When you file your taxes, you said on April 15th. There is not an extension to that. You need to make that by April 15th, that contribution.
Right.
SEPs and such may have slightly different rules, but these are just traditional IRA contributions. Review 2018 spending. No better time than now to look back and see what that looked like for the year. And utilize HSAs, health savings accounts. These are basically tied to high deductible medical plans. The contribution limit for individuals is $3,500 in 2019 and $7,000 for family coverage. And you can also do a $1,000 catch up if you're 55 or over here, not 50 like in the IRAs or 401ks. Here it's 55 and over. The other thing I should note is if you are 55 and over, or your spouse is, and you're not collecting Medicare, then your spouse could open an HSA and make a $1,000 contribution for him or herself. Something to keep in mind, and if you have any questions about, talk to your SilverOak advisor. Also review your Social Security statement by going out to your My account at the Social Security website. And then a couple other basic ones. Review estate documents, that's always important. Look at beneficiary designations. Rebalance your other investment accounts, and make sure you have proper insurance coverage. These are all things your SilverOak advisor should be discussing with you throughout the year, but we wanted to make note of them nonetheless. If you haven't received your credit report lately, we would encourage you to do that. I think it's easiest to call this number rather than use the website, but you can do either or. And if you haven't frozen your credit, use these websites to do so. One is for Equifax, the other Experian, and the last one is TransUnion.
And make sure you keep your pins.
Yes.
Because if you need to unfreeze, you'll definitely need them.
Makes the process a lot easier. So with that, we encourage everyone attending, if you have any questions, to reach out to your SilverOak advisor. If you have topics or questions that you want addressed on the next webinar, we really would appreciate those. We always are looking for feedback and input. Otherwise, this is the conclusion of today's webinar. We want to thank everybody for attending. Have a great day.